There are renewed hopes for another rate cut by the Bank of Canada next month and at the next few meetings, as we got signs of further cooling in inflation in Canada. Let's get more from Jimmy Jean, VP and Chief Economist at Desjardins. Jimmy, always great to talk to you. Thanks for coming on the show.
Thanks for having me.
People seem to think it's pretty well a signed, sealed and delivered deal that they'll cut interest rates again in September.
Absolutely. I think that was the case even going into those numbers, because we have seen the recent deterioration in the labor market. We know that credit continues to tighten. We saw that in a report by the Bank of Canada yesterday. But now that cool down in inflation, right in line with expectations, and you look at the internals of this report, and it's not just a one-off here and there. It's really broad-based. For example, you now have 49% of components that are growing below 1%, and whereas the share of components that are growing above 3% is now down to 30%. It was at 78% at the peak in 2022. So we've come a long way, and that's why you're seeing the Bank of Canada focusing more on downside risks to growth rather than upside risk to inflation at this point.
Were there any concerns, though, when you get into the fine print, for example, shelter? I mean, that's been fueling inflation.
Yeah, shelter has been the main sticking point of inflation, right? But we saw some encouraging signals nonetheless with that report. We saw rent, for example, on a monthly basis rising only 0.2%. It was very subdued as well in June, so that gives a little bit of hope. We've seen the year-over-year in rent fall down to 8.5%. It was 9% only back in May. So these are our first signs of improvements. We know that the shelter component is also pushed up to a significant extent by mortgage interest costs. Now with rates moving lower, that eventually will fall down. But for the time being, this component still reflects the effect of renewal. So this is sort of mechanical, and the Bank of Canada knows to look through that. But I would say what we've seen in rent and also in other components of shelter costs, water, electricity, utilities, those prices are actually, some of those prices are actually negative. So we are seeing deflation. So that's very encouraging.
The core measures, they look okay as well, excluding food and energy?
I would say so. June was a little bit worrying because we had seen, for example, the 3-month annualized average for core measures pop up, and now it's come back down a little bit. So that gives a good indication for the direction of travel of core inflation measures. And like I said, with the distribution more and more looking at like what we used to know before the pandemic, I think the Bank of Canada will find reassurance that core inflation will certainly fall into place and converge towards that 2% target. So I would say at 2.5% inflation, generally speaking, whether you look at headline or core, pretty close to that. It's no longer a situation of crisis in inflation. And you're looking at this report knowing that import prices have been increasing. You have the events in the Red Sea. So, the fact that we were still able to show a deceleration, it shows what's really happening in the domestic economy with consumers retrenching. We see how goods inflation is now down to only 0.2%. Consumer spending on durable goods has been affected and will continue to be so because lenders are tightening credit, like I mentioned, and that has an impact on big ticket items that tend to be financed by credit. So the Bank of Canada knows that its monetary policy is working, and that's why I think the question now is whether they'll deliver sufficient cuts to preserve that soft landing.
Did you say the rate of goods inflation now is 0.2%, essentially flat?
Absolutely. And it could even go into deflation because that's indeed what we're seeing in the U.S. So there's even further room to run. But at the same time, we know that import prices right now are reversing a little bit. And that tends to feed over time in goods and inflation. But nonetheless, I mean, those are very satisfactory numbers. What's been really sticking has been services inflation. We saw that come down as well in the month of July. So, I mean, overall, there's not much not to like about this report. If the data continues to go in that direction, the Bank of Canada, like I mentioned, the focus really has to be on the labor market, because if we start to lose the labor market, then we're in trouble.
Can you generalize about the labor market? I know unemployment has been going up, but is the labor market weakening significantly in Canada?
Yeah, unemployment rate has gone up, but of course we need to qualify that given the extent of population expansion we've seen. So it's a story about a stronger participation. However, the last 2 months have seen weaker numbers outright, and that's despite still strong demographic expansion. You're seeing the employment to population ratios fall down, significant increases in unemployment among the youth, among newcomers. And, I talked about the retrenchment in credit. We happen to see that more for renters, for lower income, for younger individuals. So that's where the risks really are. And that weakness in employment is certainly not a good signal for consumer incomes going forward. The hope, I think, by the Bank of Canada is that this doesn't generalize to the core of the labor force, aged 25 to 54. So far, so good for that segment of the population. But I think the Bank of Canada wants to address that and make sure that monetary policy conditions are made easier, fast enough in order to prevent a hard landing.
Are we moving towards a situation where we've got a slowing economy with too many goods chasing too few purchasers? In other words, could we see actual deflation in some areas?
We are seeing indeed deflation in some areas. Take, for example, vehicle prices, used vehicles. That's where we saw pretty significant inflation during in the wake of the pandemic, given the lack of availability for some models. Now we're seeing the opposite of that. Inventories have been replenished. And you're seeing, for example, used vehicle prices down 5.7% year over year. So, you are seeing that deflation. We've been seeing deflation for some time in cellular phone services. We've seen it in travel services as well. And that indicates maybe a fatigued consumer, maybe less traveling, given the pressures on households' budgets. So this is happening. This is where monetary policy is having an impact. It is on discretionary spending. So the recipe is taking hold. It's working, but we just have to make sure that we don't go overboard, because let's remember 5%, which is the peak policy rate that we reach in Canada. That's very, very restrictive for an economy as indebted as Canada. The Bank of Canada knows that. That's why I think they go with cuts at each meeting until the end of the year. And I expect 6 rate cuts in 2025.